she has a rule that says if she has no so-called headroom, then she's either got to cut spending more or put taxes up more. The problem with these interest rates going up for her, the cost of borrowing, is that there doesn't look to be any headroom there at the moment, and that's why people think taxes are going up again.
Yeah, fiscal rules sound really credible because the idea is you have a rule that forces you to stay on the straight and narrow. But sometimes, as you know, Robert, fiscal rules can constrain you. And if you have a rule that constrains you and actually forces you into a sort of corner, then you ideally should actually get rid of that fiscal rule. But the Chancellor, for whatever reason, feels reluctant to do that. Obviously, like most rules, the best time to change them is when you're in a good position. If you change them when you're in a difficult position, the markets think, gosh, you're trying to get yourself out.
Gerard, great to see you. We meet as the government's long-term borrowing costs, the yield on the 30-year gilt, have reached levels, highs, that we haven't seen actually since the late 90s. Now, we're seeing rising borrowing costs for governments across the Western world. Germany's borrowing costs are rising. Actually, one of the things that's very striking is that in America, the interest rate set by the central bank has fallen and actually borrowing costs for the government have gone up, right?
That's right.
So there are borrowing costs going up all over the world. So I guess the question is Rachel Reeves a victim of global conditions, or is at least some of this rise in what she pays to borrow a problem of her own making?
Hello, it's great to be on the show. Thanks for asking me. In answer to your question, I think it's a combination of both domestic factors and global factors. There's two things that have changed here in the UK, particularly in recent months, that have pushed borrowing costs up. One is that the financial markets are far more concerned about persistent inflation, and that will limit the extent to which the Bank of England can eventually cut interest rates. And the other factor is worrying about the government's borrowing. Government spending is high. The Labour government inherited a very difficult situation. But as we started the new year, many economists, as well as the financial markets, often sit back and reassess the situation. And one of the things they've reassessed at the beginning of this year is concern about the future fiscal options in terms of government spending and taxation. So those two factors are domestic, namely worries about UK inflation and worries about the future policy options for the Chancellor. But then against that backdrop, there's the global picture. Now, it's fascinating that in the States, the US has become very optimistic about future policy under President Trump. The rest of the world has become more concerned. But in between the two, what's happened is financial markets in America now think that the US Federal Reserve, their equivalent of our Bank of England, won't be able to cut US interest rates. And that's had an impact also in terms of thinking, not just in the States, but globally. So it's partly global, but it's also domestic as well. The challenge, of course, is high borrowing costs start to feed through to the whole economy, impacting the level at which companies can borrow. It starts to deter business confidence, and also it starts to seep through also into the mortgage market as well. So it has longer term ramifications if indeed interest rates and borrowing costs remain high.
So how worried do we need to be, Jerry? Because that sounds like quite a pessimistic picture.
Yeah, well, I think we should be concerned, but not yet pessimistic. The global backdrop is far more uncertain than usual just because of the change in US president. But in terms of the UK itself, the budget a few months ago had a very negative impact. There was a very positive aspect to the budget in the sense that Rachel Reeves wanted to address longer term investment, which has been far too low for far too long. But the positive impact of that takes some time to feed through. Against that, what we've seen is a reaction to the increasing taxes in terms of taxes on national insurance. Whichever economy one looks at, whether it's America or Britain, the outlook depends on the interaction between the economic fundamentals, which are mixed, the policy outlook, which is also mixed, and confidence. So fundamentals, policy and confidence. And the key thing, Steph, is that in the States, confidence is really riding high, but here in the UK, confidence is very low. So I think a key thing is for the government here and Rachel Reeves to try and get on the front foot, to try and start to reassure people about confidence about the outlook. But the underlying fundamentals and policy options are still very difficult, even allowing for that.
I mean, one of the things that worries me when I talk to investors controlling very large pools of money is how gloomy they've got about the UK's growth prospects. We've got stats at the moment which show basically zero growth in the UK economy. Most economists are downgrading how much they expect the economy to grow in the current year. This is a government that says its number one ambition, its number one mission is to get the growth rate up. But when I talk to investors, they say they don't believe they've got yet a persuasive plan. And the problem, given the kind of concerns you've just raised, it's a double problem, because if growth bumps along, tax revenues don't come in the scale that they need, and we're in, therefore, to another wave, potentially, of tax rises, another set of tax rises, which the Chancellor has said she doesn't want to do. So, are you as gloomy as these investors about the growth outlook? And if you were the Chancellor and you wanted to persuade these investors to take more of a chance on the UK, what would you do?
Okay, a whole host of issues there. Right, if we want to reassure ourselves, we're not in isolation. Many other countries are in the same boat. Not that that often helps. In fact, the biggest challenge is facing Western Europe. So Britain, Germany, France, Italy, the four major economies of Western Europe, are facing this difficult challenge of not only a weak immediate economic outlook, but adjusting to the changing global template. America is trying to make itself more competitive. The Indo-Pacific region over in Asia is becoming far more competitive. So we don't only have immediate challenges, it's about trying to reposition the economy so it becomes more competitive longer term. And it's important to mention that because the policy levers that, if you're the Chancellor, that you want to pull are not only aimed at helping you now, but hopefully will put you on that right path for the longer term. So what should the Chancellor do? I think we need to put it into three pots, and the Chancellor herself, unfortunately, can't pull the levers for all three pots. One is fiscal policy, to reassure the markets about the fiscal outlook. The fiscal outlook is the combination of government spending, taxation and borrowing. Unfortunately, spending is high, taxes are already high and borrowing's high.
And just on that, because she has a rule that says if she has no so-called headroom, then she's either got to cut spending more or put taxes up more. The problem with these interest rates going up for her, the cost of borrowing, is that there doesn't look to be any headroom there at the moment, and that's why people think taxes are going up again.
Yeah, fiscal rules sound really credible because the idea is you have a rule that forces you to stay on the straight and narrow. But sometimes, as you know, Robert, fiscal rules can constrain you. And if you have a rule that constrains you and actually forces you into a sort of corner, then you ideally should actually get rid of that fiscal rule. But the Chancellor, for whatever reason, feels reluctant to do that. Obviously, like most rules, the best time to change them is when you're in a good position. If you change them when you're in a difficult position, the markets think, gosh, you're trying to get yourself out. Let's step back. If you have a fiscal challenge, as we have in Britain, there's effectively 5 ways out. You grow the economy, you reform, you tax, you curb spending, or you borrow. The ideal way out is economic growth. So if the markets became confident about economic growth, then they will start to become less worried. Of course, you could try and reform. Reform is very much in terms of public services. So public spending can be more efficient. So it reduces the upward pressure on public spending while still being able to deliver what the general public wants. Again, that takes time. The ideal way out is to have the world economy picking up, and that gives us some nice tailwinds. Lower oil prices this year could help. So it's possible that growth could come in helping it out.
We'll get on to Trump, but actually there are perfectly good reasons to fear that won't happen.
I think.
And no government anyway should subcontract the fortunes of its country to sort of events outside its own borders.
That's right. Well, so come back to controlling the controllables. So I was saying earlier, you've got 3 things if you're Chancellor. Fiscal policy, you need to reassure and hopefully start to pull levers that make people more confident about the outlook. Second, there's monetary policy, which is obviously outside the Chancellor's control. That's the Bank of England. UK interest rates are relatively high now, 4.75%. I think interest rates will fall this year. I've read the inflation interest rate picture quite well. So my feeling is that the markets can sometimes get ahead of themselves. Now the markets have been pulled back. The markets 3-6 months ago thought interest rates would fall aggressively. Now the markets in the UK think interest rates will fall gradually. And bottom around 4%. So I think interest rates will come down. So 4.75% now, we'll probably get 3 rate cuts by the autumn. That helps. Then the third factor is the supply side, the magical supply side. The best way to think about this is all the eyes. If you're the Chancellor, you need to encourage not just the general public and general businesses in the UK, you need to encourage the international investors you asked about, Robert. And there the eyes are innovation, investment, infrastructure, and incentives. All of those need to be aligned. And sometimes it takes a lot of time. As I said earlier, the budget, even though the budget got a thumbs down generally, one important aspect of that was measures to try and turn the investment picture around. And this has been a problem for 30, 40 years. So putting it all together, what should the Chancellor do? She should basically address the worries about the fiscal side. Hopefully, the Bank of England will step in to help her with interest rate cuts while keeping inflation under control. And then it's putting a whole host of measures in place to address the supply side. Of course, growth is the issue. If growth disappoints, as you mentioned earlier, it makes everything far more complicated.
You know, the Chancellor said to us when we interviewed her after the budget that she really didn't want to put up taxes again. But it sounds like from what you're saying, given the picture you've just painted, that she inevitably is, though, isn't she? And, you know, talking to businesses at the moment, the addition to the national insurance contributions, the change in business rates for retail and hospitality sector, the increase in the minimum wage, this is all absolutely hammering businesses, and yet there could be more.
Well, the tax on national insurance for jobs was a bad decision, quite frankly, and that doesn't help. But on top of that, the way you pose your question really touches on where everyone is at the moment. They're starting to sort of double guess what might come next. It's important to stress that a higher tax take is already factored in for this year. So the Chancellor, in all likelihood, won't have to do anything this year on the tax front. Obviously, we have additional challenges with the comprehensive spending review, which is going to add to pressure on public spending at home. President Trump is likely to force the UK and other Western European countries to step up more in terms of defence spending. So those external pressures are there. So if you have public spending under upper pressure, it comes back to those options I touched on. Growth hopefully will start to deliver for you. If not, then you need to start to think about comprehensive reform.
I mean, one of the things that people don't seem to have noticed is that the Chancellor has asked the Office for Budget Responsibility to provide another fiscal update in March. Right? March 26th, I think, from memory. If, as seems likely, that says there is no headroom, right, she'll be in a very difficult position because you say no more tax rises this year. I'm not so sure if what we see in March is that a tiny amount of headroom at the moment goes negative.
OK, what the Chancellor needs to do if the OBR comes back in March is to really try and get on top of the situation. You need to actually win over confidence of the markets at home and overseas. And the point is, it's the fiscal rules that you touched on earlier. The OBR, I think, has done a very good job. In fact, they've read the economy very well. They're the independent forecaster. They were quite
So
upbeat.
You don't share Liz Truss's. You're a great ally of Liz Truss. You don't regard the OBR as this liberal conspiracy to bring down, essentially the right of this country.
Well, I met Liz Truss twice before she became PM. I'd never met her again after she became PM. In fact, to be frank, I had more breakfast with Alistair Darling when he was Chancellor than I've ever had meetings with Liz Truss, but no one ever says you were Alistair Darling's advisor, etc. The truth of the factor, as you know, Robert, you meet all these politicians because you try and give them advice. But the OBR, actually, there's an external review of taking place of the OBR that reports in February. So I was one of the experts brought in to speak to these two people from the Netherlands. And I basically gave them my view that I thought the OBR was very credible. The challenge, of course, with the OBR is that many of their forecasts are seen as being absolute truth. And the margin of error, not that we should be talking about margin of errors on podcasts, is that, look, 1 year ahead you can be out. It'd be a bit like you trying to predict Arsenal and me trying to predict Fulham. At the beginning of the season, our forecast can be sometimes right the mark. The OBR, usually 1 year ahead is 0.5% out in terms of their forecast of the economy.
What we're saying here is basically they do a pretty credible job.
They're pretty good.
On the margin, they're as good as anybody out there, is what you're saying.
Actually, I think Richard Hughes, who runs it, has done a very good job. So I hope he sort of stays there. But the challenge, of course, is these fiscal rules. One of the difficulties in recent decades in the UK is because economic policies lack credibility, often the Chancellor of the day, and it's not just Rachel Reeves or her predecessors immediately before her, whichever Chancellor it is often thinks we should have a monetary rule or a fiscal rule. And often what happens is, in the good times, it's like adding fuel to the fire, and in the bad times, it's like being in the hole and digging deeper. If your fiscal rule says growth is weak, your tax revenues are not going to be as high, your budget numbers are not going to be met, hey presto, what must you do? You then start to cut spending or raise taxes. But if you're an economist, you think, and if you're of Keynesian persuasion, as I tend to be, you tend to think, well, that's the worst thing you do. You need to actually sort of say, this fiscal rule is not fit for purpose. The challenge to reuse that word is that if you're changing the rules, it's often better to do it when you're presenting them in a credible way and not when you're sort of back against the wall.
So she can't change it now, because if she changes it now, markets will say she's cheating, and her credibility will be even lower than arguably it is now.
Okay. If interest rates start to fall and if inflationary pressures start to ease, then the Bank of England will be able to cut short-term interest rates, and longer-term borrowing costs, which are currently very high, should start to ease off their current highs. That will make that backdrop very positive, or less negative than it currently is. On top of that, it's important to have a credible policy, saying you're combining fiscal policy, monetary policy, and the supply side agenda. So we've got a credible policy for growth. The difficulty, of course, is that if the economy underperforms, then you get back to the really difficult questions. Of those options, growth, reform, taxes, austerity, or borrowing, if growth doesn't deliver, and if you're not delivering on reform, then there's no easy way out of it. You have to think of those other three areas: curbing or controlling spending, raising taxes. If you start to do both of those in terms of curbing spending or raising taxes in difficult economic times,
it's a death loop.
It's a death loop. Or you borrow more. But of course, the shock absorber is that if the economy underperforms, then interest rates could and likely would fall by more than we are talking about. So it's not as if, though, things can't be moved. The global backdrop, of course, is one where, as we've touched on earlier, there's so many other factors at play. So no one should kid themselves it's an easy outlook, but it's trying to retain business and consumer confidence at this sort of difficult time.
One of my kind of beefs around this, Gerard, is whether monetary policy really works anymore, though, in the sense of, we keep talking about the global backdrop, which impacts so much in terms of our inflation here. Do you think it works? I know, I've heard you talk about monetary policy before and had criticisms of it. So what do you think now? Do you think it works?
Well, I think we've had a whole long period of poor monetary policy in the UK. Like the day Russia invaded Ukraine, which did add to inflation, UK inflation was already in more than 3 times the inflation target, almost approaching 7%. So monetary policy was on the wrong path before. Interest rates were kept too low for too long. That led to asset price inflation, led markets to not price properly for risk. It meant zombie companies stayed in business, growth companies couldn't access funds, and inflation picked up. Even though inflation at the moment is relatively low, the reality is that the cost of living in terms of the price level is 30% higher than 3 years ago. So most people are still feeling the pinch. So in that respect, Steph, it's difficult to reverse that. So you might feel that monetary policy isn't working in terms of being able to reverse that sort of cost of living aspect. But the point you touched on is a critical one. Not everything is under Britain's control. So what the Bank of England needs to do is to be on the front foot to curb domestic inflation pressures. Service sector inflation is pretty high in the UK at 5%, which is largely, not wholly, but largely reflecting domestic pressures. So monetary policy can work, but you've touched on the key point, which is that the external environment, which is outside our control, is exerting a big influence. Now, it might be the case that oil prices turn out to be much lower this year because a lot of bad news has been factored in terms of geopolitical risks into the oil markets. So we might be lucky and get lower oil prices if it starts to help. Food prices might not sustain their high levels as a result if oil prices come off. So there might be some helpful tailwinds, but the uncertainty is the tariff impact.
I mean, an argument that I would make is that it's absolutely clear that business confidence has collapsed and consumer confidence is low. Inflationary pressures are therefore, in my view, lessening really pretty fast. But the Bank of England spends all its time looking in the rearview mirror at data that is out, that is no longer relevant.
Yeah, I've been saying the same for months. Monetary policy used to be forward-looking. We used to say that, economists always took the view, and the Bank of England, that changes in interest rates and monetary policy more generally. So it's not just interest rates, it's quantitative easing. The Bank of England is actually making the problem worse because they're pushing up gilt yields by actually selling government debt. They should stop doing that. That would take some of the pressure off. And indeed, they could start to buy government debt if they wanted, but they should at the very least stop selling that. It might sound esoteric and a technical issue, but it does have widespread ramifications. But on top of that, the Bank of England needs to restore some confidence. They don't communicate well. And instead of being forward-looking, they're very coincident. So that means that instead of taking actions now on policy that will impact in 3, 6, 12, 18 months, they're responding to the latest data. So they need to get ahead of the curve. The Chancellor has tried to do that through the budget. The Bank of England tends to always be reactive and coincident. So monetary policy hasn't been good in the UK. If we contrast the Bank of England with the European Central Bank, partly because Germany and France are much weaker, the European Central Bank is cutting rates far more aggressively. And what's also happening is America doesn't feel the need to cut interest rates as much because the US economy looks very strong. So Britain suddenly is caught with the markets thinking UK rates should be more like American rates, but at the same time, our growth picture is as poor as the growth picture on the continent. So we're caught between having interest rates much higher than the real economy needs in the UK. But the reason for that is because inflation is far more persistent in the UK. So it's a very difficult monetary policy background. Gosh, we're going to make all the listeners sound really pessimistic here. But the reality is that the economy is in a difficult situation. It's not been run particularly well for the last few years. Debt levels are very high. But unless you get the growth picture coming through, then you are forced to make some very difficult decisions. But if you're forced to go on autopilot to think it's spending cuts or tax increases, then you actually make the economic picture probably even worse. So you need to start to really force through those reforms, try not to raise taxes. Energy costs we haven't talked about. UK energy costs are the highest in the world. That is really having a damaging impact on business. Now, I'm very much in favour of the green agenda. I'm on the advisory board of the Grantham Research Institute. And so we need to address the energy crisis. What we have in the UK is we're going on a slightly different path. Other countries are having energy addition. We're going for energy substitution. What does that mean? Like, take Norway. They're very on the front foot on the green agenda. They're bringing on renewables. But at the same time, they're still going into fossil fuels because they need to keep energy costs down. And the argument with energy addition is that renewable costs start to come down. That starts to push out the fossil fuels. We've leapfrogged into sort of trying to substitute renewables immediately for fossil fuels at a time when the so-called baseload, the reliability of them is not so high, so the cost is high. So that means that we have high energy costs. So given that we're not going to change our energy policy, the question is there a plan B? And the argument is we should start to break the UK energy market into regions. So that would allow places that are rich in high in wind suddenly to benefit, and we don't have to turn the grid off. So we need to basically, without reversing policy, we need to actually start to think more intelligently to start to address the energy crisis with your commitment to renewables if you're going to stay on that path, but then start to reduce the energy costs. The point is that there are levers that can be pulled. And the other thing is the planning reform. A year ago, economists in the FT survey were asked, what's the one thing that you would do if you could run policy? And there is a real danger when all the economists say the same thing. You tend to think run for cover. But practically all the economists a year ago said change planning reform. For whatever reason, the Conservatives didn't do that. Labour, to their credit, is changing planning reform. You need to execute that, because if you do that, then suddenly it makes it easier to build properties. Obviously, they're pretty expensive to buy and to rent, but also it should make it easier for planning reform for businesses, etc. So there are things that we should be doing. So it's not just about fiscal policy, government spending, taxation. It's not just about monetary policy, interest rates and the Bank of England. There's also supply side measures aimed at trying to reduce energy costs, aimed at planning reform, and also ultimately trying to ensure that investment remains high because you want to either restore or retain business and consumer confidence as well.
I know you mentioned earlier on in this chat about China, and the Chancellor's taking this delegation to Beijing this weekend. We've already got China with, various fingers in pies in terms of our sectors here, like energy and infrastructure and things like that, and so many different parts of our life. Do you think that's where this investment is going to come from? We need that.
Yeah, the low investment, unfortunately, has been a perennial issue in the UK. I'm sad to say that I remember writing an article in the Times in 1991, which caused a stir at the time. And it was about the low investment in the 70s and the 80s. So we're talking about a 50-year problem. And when you have a 50-year problem, the reality is that you can't solve it overnight. And again, that's why it was good in the budget. Investment was put front and centre stage. But addressing it requires not just international investors, it also requires changing things here in the UK.
Steph just mentioned that over, let's say, the last 15, 20 years, we have seen in the early period governments desperate to get Chinese investment. We then went into a latter phase, moves from sort of May to Johnson to Truss, where the Tory party then decides, Rishi Sunak used these words when he was Prime Minister, that, essentially China is an enemy. They pose the greatest threat to global security of any nation. These are words that Sunak as Prime Minister used. We now have rules that say that China cannot invest in certain strategically important industries, so they're barred from nuclear. We're stripping out any Chinese involvement in our telecommunications networks. We all remember the furore over Huawei. We've got Rachel Reeves, some would say going cap in hand to the Chinese, saying, please, 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 forget about all those other Tory governments who didn't like you. We like you. Please invest. First of all, the Chinese, you work for an international bank for ages. You spent a lot of your life in the region. How do you think the Chinese will react to Rachel Reeves going over there and saying, we want to be friends now? But secondly, if you are a British government, what areas is it, in inverted commas, safe to secure Chinese investment in?
Yeah, I should say that I'm the senior independent director of the Bank of China here in the UK. So I follow China closely, but obviously my views are independent. Let me answer that from a Chinese and then coming more crucially onto the UK side. From the Chinese perspective, they're trying to move up the value curve. Their economy needs to transition. In Trump's first term, they were hit by tariffs and they moved to what's called a dual circulation, self-sufficiency in food, fuel, technology. But to move their economy up the value curve, they need a deeper and broader capital market. So from their perspective, deeper financial ties with the likes of Britain would be beneficial for them.
So tell us what you mean by that. The City of London helping Chinese companies to borrow. Is that what you're saying?
Oh, well, it's a case of opening the Chinese market so UK asset managers and fund managers can put money into China. The Chinese bond market really needs to develop. It's also allowing China to start to issue renminbi Chinese currency bonds in London. One area is the green agenda in London, where the green market in the City of London really is in a pole position globally. The Chinese could help that in terms of actually issuing more, maybe dual currency, i.e. in sterling as in Chinese currency. So, it's very technical, but the point is...
it's not technical, because actually I think, the question for me is why, in the end, isn't this a sort of national security issue? I'll tell you, why I frame it in that, because, let's be clear. If you talk to people who work in intelligence, they think there is a very significant risk that China will invade Taiwan, or at least act really aggressively in respect of Taiwan. Everybody says 2027 is the year when people are fearful some really dramatic erosion of Taiwan's independence and freedom will take place. If we are at that stage, if the City of London is inextricably linked to China's financial markets, imposition of sanctions will become harder. Our ability to conduct economic warfare will impose greater costs on us. Why do we want to become, in a sense, more dependent in terms of our income on China and China's market?
It's not a case of becoming more dependent, but two aspects to it. Let's talk about the general picture and then come on to the city. I think the issues you've raised are ones that need to be centre stage. And what I've written and argue is that we need to be very mindful and cognizant of the changing global geopolitics. And we need to differentiate, not just with China, but other countries as well. We need to differentiate between strategic and non-strategic areas, much as America does when it deals with China. America has a hardline approach in terms of defense, security, intelligence. So should we. But the other side of that is that you need to allow trade, finance, and many parts of the business community to still interact, as American firms do with China. We need to have clarity about where those red lines are.
But are the Chinese going to be all right with that? Because you kind of said you can have a bit, but you can't have everything. So are the Chinese just going to stuff you? Like, you need to give us more or we're not going to help. Like, you can't cherry pick for us.
Well, I think you've hit one of the nails on the head. We need to be going into these relationships eyes open, and we need to actually be mindful of what's in our best interests, much in the same way in which we go into any relationship with any other country. The point is that it's not that we want to choose one over the other. We just have to be cognizant of the fact that China has accounted for a third of global growth in the last 20 years and is the second biggest economy. But when you look at the geopolitics, it makes it even more difficult now than before, because effectively we have a G3 world emerging. Group 1 is America and its allies, which includes the UK. Group 2 is China and its allies. And then Group 3 is the sort of what might have been called the global south, but they've been referred to as the middle ground powers in recent years, the likes of India, Nigeria, Brazil, big economies. And these are countries that we should also be deepening our relations with. So Robert's
But isn't the concern here that most of them are gravitating towards China rather than us?
I wouldn't say they're gravitating towards China. If you go to India, they're trying to have it both ways. That's why the G3 world has emerged in some respects. They don't want to be seen to be in America's back pocket, but they also don't want to be in China's back pocket. But the issue really is the one that should concern us, is that in the last few years, we've had a globalized world economy, which has been pretty beneficial, although the flip side of that is that those people on low skills and low wages in the West were the ones who suffered the most in this. We now have a more fragmented world, and the fragmentation isn't just with China and those countries in its sphere of influence. It's now also with US tariffs basically adding to that fragmentation. So we in the UK need to have sensible relationships with, quite frankly, those big players, with America, with our continental partners, with the middle ground powers, and also with China. We shouldn't actually be trying to blur that distinction between strategic and non-strategic. When it comes to the city, the hallmark of the city has always been that it's almost been above the politics, and it's been a good place from which you could do business. It becomes far more difficult now, and therefore the questions you've raised are very valid ones. You need to have very business-type relationships. And so what does it mean for the UK? You can't be naive about it. You need to actually sort of have trying to come back to our points earlier, you need to be setting your domestic policy on the right footing. And at the same time, you need to be supplementing that with your sensible global strategy as well. Defence spending is going to become a bigger area. That aligns us even more with the US, quite frankly.
You've mentioned we're moving into this age of protectionism, mercantilism. We've heard Donald Trump talking about doubling down on imposing, enormous tariffs on Mexico, on Denmark. If Denmark doesn't hand over Greenland to America, he talks about, imposing the mother of all tariffs on Danish exports. I don't know what consumers of Ozempic in America and all those weight loss drugs produced by Novo Nordisk are going to feel if Donald Trump decides to double the price of Ozempic. But the point is, it looks as though he's going to make good on at least some of what he said in terms of putting up tariffs, frankly, on anybody who trades with America and massively on China. If you were making policy in Brussels, if you were making policy in Westminster, would you be preparing to retaliate against American tariffs, or would you just take the hit? What would you do?
Okay, the US approach is not the ideal one. So we have to wait to see how high tariffs are and how they are applied. So basically how high and how wide they are. And then the question is how companies respond and how countries respond. what we know from history is not only that tariffs themselves aren't a sensible policy, but often what makes it worse is beggar my neighbour policies, as they used to be called. That if you respond to higher tariffs with higher tariffs, then it makes the global picture worse. What we did in Victorian times actually was to stay in Britain on the free trade path, but we were in a much stronger economic position then. So in answer to your question, no, what you do is you hopefully sit down and negotiate in terms of what are the areas where we can cooperate on.
I mean, last time there were tit-for-tat retaliations when Trump imposed tariffs. The politics of it suggests to me we will see that again, but economically that will lead to lower growth and higher prices.
Yeah, what it means is that if you're being hit by that, then you start to seek out export markets where you're free of the tariffs elsewhere. You then have to be...
Well, there we are. As a Eurosceptic, what you're saying is we should negotiate a better deal with the European Union. We should rejoin the single market. That's what you're saying, isn't it?
Well, you don't want to rejoin the single market or the customs union, but you actually need...
Yeah, but you're saying we should seek out markets where we have better terms of trade. So why not in a world where Trump is imposing tariffs? You know, surely the advantages of rejoining the single market increase.
No. What we need...
But why?
Let's bear in mind the fact that Europe at the end of last year started to impose tariffs on a whole host of countries. What you actually find is that if you start to go from globalization to fragmentation, everyone starts to get into a more difficult situation. What you also need to be doing is actually coming back to the earlier point is about having domestic policies that make you more competitive. If you wanted to say, is there any sense to any of these policies from the US side? I would not be advocating any of these policies, but what you have to be mindful of is back ahead of the global financial crisis in 2008, the IMF called together 6 country/regions who all had big imbalances. China had big surpluses, Europe or Germany had big surplus, Saudi Arabia had big surplus, US had big deficits. And the argument was that the surplus countries needed to be opening their markets more and spending more. And the argument then, and it's a strong one, economic grounds made since the 1930s, that if all the pressure is always on the deficit countries, that you make the outcome worse. So you therefore need to have policies that encourage people to willingly come to the table and open their markets and start to spend more at home. So in terms of the surplus countries, China, Germany as well, and 1 or 2 in the Middle East, they need to come more to the table in terms of boosting demand, opening their economies. Of course, Germany has been sort of scuppered by 3 key parts of its economic backdrop changing in recent years. They used to rely on selling cheap cars to China. Now China is actually exporting to Germany. They used to rely on cheap energy from Russia. That's now gone. And they used to rely on NATO to fund their defence spending. So the difficult situation in the German economy is going to be there for some time. So coming back to Robert's point, it's about having a sensible relationship with the EU. It's still a big export market for us, although it's declining as a share of overall global trade. And
it's still an enormous market.
Absolutely. If one looks, what's fascinating is that Western Europe, including the UK, in 20 years' time will be less than 10% of the global economy, less than India alone. So as all these debates are taking place, we almost need to step back and look at the world economy in a very different way. You need to have a sensible relationship with your neighbours, but the shift in the balance of power is to the Indo-Pacific. And you need to almost look at the world with the atlas the other way around, with India on the left, on the west, America and the Pacific Rim on the east. What Trump is trying to do is to make, it's not only America first, he's trying to make America more competitive. I don't agree with his policies on this front. But what we need to be doing is positioning ourselves in those growth markets elsewhere and also at home, making ourselves more competitive. And unfortunately, coming back to the single market and customs union, many of the areas where there can be growth in the future are where the UK might be able to benefit from regulatory control itself, IT, etc. You don't want to be sacrificing that regulatory control in those key growth sectors of the future. So we need to sort of be mindful of how the politics has changed as well as the underlying economic fundamentals changing as well.
Robert and I were talking in a recent episode about this being, you know, a really important year. Robert reckons this is one of the most important years ever. We can often sound quite gloomy when we talk about economics. And we talk about AI a lot and the potential that's going to come from that. What's kind of getting your, for want of a better phrase, your juices going in terms of like, oh, this is going to be good for the economy, this is where we need to focus? Like, is there anything that's kind of exciting you in terms of economics at the moment, rather than just all the problems?
All right, well, let's go with the problem first, because that's centre stage. Financial markets have moved from a focus on inflation a few years ago. Their current focus is on growth. And in the next 2 to 3 years, the focus will be on debt. So we're going from a financial market focus away from inflation to growth to debt. Debt is a real issue, not just for Britain, but for most countries around the globe. 6 of the 7 G7 countries, the 7 industrialised countries, Germany's the exception, are potentially in the debt trap. Debt levels in a couple of years will be above 100% of GDP. Growth will be weak, interest rates high, and they're unable to run what's called primary surpluses to get that down. So,
and just so I need to explain to people listening, what that means is broadly that you get into a situation where simply paying the interest on your debt means that your overall debt burden rises. You're borrowing to pay your interest, and that is unsustainable.
Yeah, it's like maxing out on your credit card and not being able to pay your monthly interest rate payment because your growth, your income is not good enough and your interest rates are too high.
In an ideal world, this problem would be tackled in a way that, to an extent, America has been tackling it, although its debt burden has also risen really dramatically and is set, if Trump does much of what he's planning to do, to rise really rather spectacularly. Nonetheless, they do have way higher growth than we have. And so ideally, you would want the West to come up with a set of policies that massively increase the growth rate, rather than going back to where we were 15 years ago, which is slashing public services and a new era of austerity. And if you were, however, being realistic about this, how great is the risk that we are going to find ourselves in another world of appalling austerity?
Well, that's the real challenge. This is why I've been saying for the last 5, 6, 7 years, we need a pro-growth agenda. And it's not just about saying it, you need to embed it. When you have a debt problem facing you, just remind ourselves of those options: growth, reform, austerity, tax, or borrow. If borrowing's high, taxes are high, and you can't really have austerity. Back in 2012-13, I came out arguing against the austerity at that time, and Robert remembers this, because I'm saying we could have borrowed at incredibly cheap longer-term interest rates, and we had that opportunity again in the pandemic. We could have locked into lower borrowing. We've missed those opportunities.
Yeah, it's a scandal. Many of us were saying at the time, when interest rates are, when effectively money is free, use it to invest.
Well, you and I were in the minority at that time, I remember back. And unfortunately, many economists are saying, well, actually, you can't trust the government to spend the money right.
Which is also possibly true.
Yeah, that's true. That's true. But coming back to Robert's question, so then of those options, you look at growth and reform. You need to genuinely reform public spending and public services so you don't have that upward trajectory on spending and taxes. That's easier said than done. Then on growth, you need to get energy costs down. So you need to do that in a way in which it's compatible with the green agenda. You need to actually make sure that your labour costs do not keep on rising. And ultimately, you need to improve productivity. But the productivity is all those I's again. It's about having innovation. It's about having infrastructure and incentives. Incentives matter, and it's not just tax, it's also regulation. One key issue that's come to the fore in the last few months is how US businesses have suddenly become very confident, because they're now expecting the regulatory environment to improve as well as maybe the tax environment to change. So you need to be mindful, obviously, of the consequences of doing things like that. But ultimately, the more difficult it becomes in the next 1 or 2 years, the question is going to come to the fore: what do you actually have to do to get economic growth up?
Look, I'm afraid you have failed us in coming up with your great source of optimism. But no matter, you're going to come back again another time when we'll have the positive agenda. I should just also, though, because some people will also have noticed that in terms of the kind of deregulation that we are beginning to see in America, enormous businesses like Meta deciding that it doesn't really matter if you put any old rubbish out on Instagram and its various social media channels, which not everybody regards as a helpful innovation, I think. But anyway, let's finish with the idea that not all regulation is bad.